Most people invest in ETFs that sound smart. Big names, solid track records, all the usual boxes checked. But here's the thing. Over time, that pretty good pick, it can quietly cost you $500,000 and over $70,000 in lost dividends without you even realizing it. So here's what we're doing. I have taken 5 well-known ETFs, one you've probably seen mentioned a dozen times, and lined them up side by side. I am taking into account total returns, dividend income, fees, risk, everything that actually matters over the long haul. Now, some of these ETFs are solid, but one of them, it stands out by a mile. I'll show you and Josh exactly why later in the video. And at the end, I'll compare all the ETFs to show how a $7 daily investment in the best one could add an extra $500,000 to your portfolio and pay over $70,000 in annual dividends. Before we get into how I actually picked the top ETFs, let's just make sure we're all on the same page with what an ETF even is, because once you understand the basics, everything else starts to click. So, think of an ETF like a shopping basket filled with stocks. Instead of buying one company at a time, you're buying a whole group in one shot. And just like a regular stock, you can buy or sell it throughout the day on the stock market. Super simple. Some ETFs are built for growth, meaning they invest in fast-growing companies that are trying to get big fast. Others are built for income. They focus on companies that pay out steady cash in the form of dividends. But the kind we're focusing on in this video? Dividend ETFs that do both. They give you cash in your pocket today and a chance for long-term growth down the line. Now here's where it gets interesting. Not all dividend ETFs play the same game. Some stick with big, stable companies that have been paying dividends for decades. Others go after undervalued or higher-yielding sectors like utilities and banks. Each one comes with a different balance of risk and reward. That's why understanding how each one is built and what it's aiming to do is a big deal when you're trying to figure out what fits your plan best. And that's exactly what we're about to do. Break down how I'm comparing these ETFs so you can actually see what matters and what's just noise. So, before we rank anything or compare numbers, let's talk about the actual criteria I'm going to use to select these ETFs, because not all funds are created equal. 2 ETFs might look similar on the surface, both paying dividends, both owning well-known companies, but when you zoom in, the differences can be massive. Here's what matters. First, I'm looking at total return. Not just the share price growth, but the combination of growth plus dividends over time. This is what impacts your wealth, especially if you're reinvesting those dividends year after year. Then there's the dividend yield. Basically, how much cash you're getting back every year compared to what the fund costs. But yield alone isn't enough. We also want to see dividend growth. Is that payout increasing year over year or staying flat? Then comes risk. Every ETF carries some risk, but I'll be looking at how volatile each fund is, how it performed during down markets, and whether it tends to bounce back quickly or stay down longer. Another biggie is the expense ratio. This is the fee you pay to hold the fund, and over decades, even small differences can cost you thousands. Lower is almost always better. And finally, there's the quality of the companies inside the ETF. Are we looking at strong, steady businesses with real profits or risky businesses with shaky track records? These are the filters I'll use to cut through the noise and figure out which ETFs are worth your money, not just today, but for the next 10, 20, even 30 years. Now let's look at our first pick, one that often tops the charts for long-term stability and performance. SPDR S&P 500 ETF Trust with a ticker symbol SPY. This ETF is one of the most popular and widely traded in the world. Launched back in 1993, SPY was the very first ETF listed in the US, and it's still going strong. What it does is super straightforward. It tracks the S&P 500, which means when you buy SPY, you're instantly investing in 500 of the largest companies in America. With just one investment, you're getting a broad slice of the American economy: tech, healthcare, finance, and more. Known for its low cost, high liquidity, and strong long-term performance, SPY is a core choice for investors seeking steady, diversified growth. And the performance? It speaks for itself. Over the past year, SPY is up about 12.77%. Zoom out to 5 years, and it's gained around 95%. Go even further, over 10 years, and you're looking at a 201.94% return. That's not just good, that's elite. You'd be hard-pressed to find another fund that has delivered that kind of long-term steady growth. Now, one reason people love SPY is the low cost. Its expense ratio is just 0.09%, which means you're barely paying anything in fees. and that matters because the less you pay, the more of your money stays invested and keeps growing. That said, its dividend payout is $7.17 per share, so while this fund isn't built to maximize income, it's a powerhouse when it comes to capital appreciation. Investors looking for total return through both price growth and dividends will appreciate the blend this ETF offers, and it's massive, $645 billion in assets. That kind of scale means it's super liquid with tight spreads and efficient trading. It's easy to get in and out without losing money to friction. As for its holdings, you're buying into a basket of America's biggest and most influential companies: Nvidia, Microsoft, Apple, Amazon, Meta, Tesla, Alphabet, and more. Technology makes up a dominant 35.01% of the portfolio, followed by financials, consumer cyclicals, and communication services. This reflects the modern economy's digital core and positions the ETF to ride trends in AI, cloud, and software. Now, when it comes to risk, SPY actually holds up pretty well. It has a standard deviation of about 12.6, and if you're wondering what that means, think of standard deviation as a way to measure how much an investment jumps up and down in value. The lower the number, the less it bounces around. SPY's number is slightly below average, which means it tends to be a little more stable than most ETFs. Not the safest thing ever, but definitely not wild either. Then there's the turnover rate, which is just how often the ETF changes the stocks it holds. SPY's turnover is super low, just 3%. That's a good thing. It means the fund isn't constantly buying and selling stocks, which helps keep costs low and your tax bill lighter. And finally, SPY's tracking error is really small. That's just a fancy way of saying it follows its target, the S&P 500, very closely. No surprises, no weird detours. What you see is what you get. This is a very solid ETF, but is this the one to choose above all? In the end, I'll compare all the ETFs to show how a $7 daily investment in the best one could add an extra $500,000 to your portfolio and pay over $70K in annual dividends. Now let's take a look at the next ETF, Vanguard Dividend Appreciation Index Fund with a ticker symbol VIG. The VIG is designed for investors seeking stability, consistency, and long-term dividend growth. Unlike high-yield ETFs that prioritize immediate income, VIG focuses on companies with a solid track record of increasing their dividends year after year. This disciplined approach to dividend quality has made VIG a cornerstone in many long-term investment portfolios. Looking at performance, VIG returned about 8.67% over the past year. Over 5 years, 68.46%. And in the last decade, a strong 161.46%. It's not the flashiest ETF out there, but it quietly gets the job done, growing your money and keeping your ride fairly smooth along the way. That said, its dividend payout rate is $3.52. While the yield may appear modest compared to more income-heavy ETFs, its strength lies in the consistency and upward trajectory of its payouts. While its fund's expense ratio is notably low at 0.05%, it enhances long-term efficiency and keeps costs minimal for investors. With $108.81 billion in assets under management, VIG is one of the largest and most trusted dividend-focused ETFs on the market. However, its diversified composition spans several key sectors, led by technology, financials, healthcare, consumer defensive, and industrials, creating a robust foundation that's resilient across market cycles. VIG's top holdings include some of the most respected and financially stable corporations such as Broadcom, Microsoft, JP Morgan Chase, Apple, and Visa, etc. These companies are known not just for strong earnings, but also for their commitment to returning value to shareholders through regular and growing dividends. Now, in terms of risk, VIG keeps things calm. Its standard deviation is 11.69, which just means it doesn't bounce around as much as most ETFs. And with only about 32% of its money in the top 10 stocks, it's pretty well spread out. That lowers the chance of one company dragging everything down. Now, let's take a look at the next ETF on our list. Vanguard Mid-Cap Value Index Fund ETF with a ticker symbol VOE. This ETF strikes a compelling balance between dividend yield, growth potential, and value exposure. It's ideal for investors who want a middle ground, not too risky, but still with plenty of upside. It bridges the gap between aggressive growth strategies and conservative income plays, offering a pragmatic approach to building long-term wealth. Over the past year, it's up 5.62%. In the last 5 years, it has delivered a return of 67.15%, and over the past 10 years, the ETF has surged 86.18%. That performance alone is solid, but what adds to its appeal is its consistency over time. This ETF invests in mid to large cap US companies that show both strong fundamentals and a proven track record of paying dividends. It's designed to capture the performance of companies that are undervalued relative to their earnings and book value, providing built-in downside protection during volatile periods. Its expense ratio sits at 0.07%, which is extremely low and helps maximize investor returns. It has a trailing 12-month dividend rate of $3.72. It pays quarterly dividends and has over $30.57 billion in assets under management. The ETF tracks the performance of the CRSP US Value Index, emphasizing companies with strong earnings, consistent profitability, and a long-term orientation. The top sectors in this ETF are financials, 17.43%, industrials, 13.41%, utilities, 11.75%, consumer defensive, 9.88%, technology, 9.85%, and real estate, 8.15%. The largest holdings include Arthur J., CRH, PLC, Newmont, and many more. From a risk perspective, the ETF has a standard deviation of 14.43%, which places it slightly above average in terms of volatility, but not excessively so. Its one-year tracking error is 9.37%, and it has a turnover rate of 19%, meaning it doesn't aggressively trade holdings, another indicator of its stable, patient approach. Next up, we have a fund that's a staple for investors chasing higher than average dividend income without entirely giving up on growth. iShares Select Dividend ETF with a ticker symbol DVY. This ETF stands out for its emphasis on consistent income generation, making it particularly appealing to retirees or anyone seeking steady cash flow from their investments. It's the kind of fund you might pick up if you're aiming to create a stream of passive income you can rely on, month after month, year after year. Over the past 1 year, the fund is up 5.11%. It's delivered a 62.67% return over the last 5 years and 80.41% over the past decade. That's not sky high, but that's also not what this ETF is trying to do. It's more about stability and dependability, not chasing big growth spikes. Now, with a trailing 12-month dividend rate of $5.15, this ETF is firmly focused on income. Dividends are paid quarterly, which aligns well with the needs of investors looking to budget or reinvest on a seasonal basis. The expense ratio is 0.38%, a little higher than some of the others we've talked about, but still reasonable given the focus on higher-yielding companies. The ETF manages around $19.95 billion in assets and is specifically designed to capture high dividend-paying U.S. companies. DVY holds about 107 U.S. companies, and it leans hard into sectors that are known for consistent dividends. Financials and utilities make up over half of the portfolio. You'll also find exposure to consumer staples, energy, and communication services. This isn't a tech-heavy ETF. Tech only makes up about 4.5%, and that's on purpose. This fund avoids the more volatile growth stuff and sticks with income producers like Ford, Altria, and Pfizer. On the risk side, DVY has a standard deviation of 15.38, which means it moves around a bit more than others like VIG, but it's not wild. With a turnover rate of 19%, it's not constantly trading in and out of positions. That's good. It means it's a patient investor, just like the people it's built for. So if your goal is reliable income over time, DVY delivers. It's not going to moonshot your portfolio, but that's the point. It keeps things stable and pays you to wait. But if you're looking for a fund that blends income and growth and does it with rock-bottom fees, the final ETF on our list might just be the one to beat. Schwab US Dividend Equity ETF with a ticker symbol SCHD. In the end, I'll compare all the ETFs to show how a $7 daily investment in the best one could add an extra $500,000 to your portfolio and pay over $70K in annual dividends. But first, let's get to know SCHD. Many investors consider this ETF a crown jewel for dividend growth, the one that just deserves a permanent spot in your portfolio. It strikes an impressive balance between income, growth, low fees, and long-term performance. Now, let's be real. The past year hasn't been amazing. SCHD dipped slightly, down about 1.09%. But that's just one chapter. Zoom out a bit, and the story changes. Up 52.61% over 5 years and 113.93% over the past decade. That's where SCHD really shows its strength. Long-term, steady performance, with the kind of compounding that builds serious wealth over time. Its trailing 12-month dividend rate stands at $1.03. Investors receive payouts quarterly, offering a consistent source of income you can count on. Whether you're reinvesting those dividends or relying on them for spending, that regularity makes a big difference in your financial planning. And just like the rest of the top-tier ETFs we've looked at, it keeps fees super low, just 0.06%. That means more of your returns stay with you. So, how does it work? SCHD only includes companies that meet some pretty strict standards, at least 10 years of consistent dividend payments, strong profitability, healthy balance sheets, and a good track record of rewarding shareholders. That screening helps weed out the flaky stuff and focus on high-quality, dependable companies. SCHD spreads your investment across a bunch of solid sectors, but it doesn't just throw money everywhere. It's got the biggest chunks in energy, consumer staples, and healthcare. We're talking companies that sell essential stuff and stay profitable even when the economy gets rough. You'll also see some exposure to tech, industrials, and consumer goods, but it avoids sectors like utilities and basic materials almost entirely. And that's intentional. It's focused on quality over quantity. Its top 10 holdings make up about 40% of the fund, which means it's somewhat concentrated but not overly risky. And it's packed with names you probably recognize: Texas Instruments, Chevron, PepsiCo, Merck. Big, stable businesses that have a strong history of paying and growing their dividends. In total, SCHD holds 103 different companies, so you're still getting solid diversification, but more importantly, it's diversification with purpose, carefully chosen for dividend strength, not just spread out for the sake of it. From a risk standpoint, it holds its ground well. SCHD has a standard deviation of 14.64 and a turnover rate of just 29%, meaning it doesn't aggressively shuffle its holdings. The 5-year tracking error is 9.78%, modest for a smart beta strategy and a reflection of its disciplined approach. Altogether, SCHD brings together high yield, strong long-term returns, rock-bottom fees, and a proven portfolio strategy. Alright, now that we've walked through all 5 solid ETFs, let's take a step back and look at the big picture. Each of these funds brings something valuable to the table. SPY is the king of total return. It's broad, proven, and powerful for long-term growth. But here's the thing, it just doesn't deliver much income. So if you're someone who wants your investment to eventually pay you real spendable cash, SPY leaves you short. Then we've got VIG. Super solid, super consistent. It focuses on quality companies that grow their dividends every year, but it plays a bit too cautious. The yield is low, the growth is slow, and over time that means less income and a smaller overall return. VOE gives you value exposure. It targets those underpriced, overlooked companies with potential, but the growth is softer, the income is decent, but not standout, and the risk can creep higher than you'd expect. It's not bad, it just doesn't lead in any category. DVY is the go-to for upfront income. It's great if you want steady cash flow, especially in retirement, but the trade-off is clear: less diversification, more sector risk, and not much growth to speak of. You get paid, but your investment doesn't do much growing in the background. Every fund we've looked at had strengths, but also had gaps. They each made you pick between one good thing and giving up another. But not SCHD, and that's why a lot of investors call this one the gold standard for dividend growth. And honestly, it's easy to see why. SCHD gives you SPY's long-term growth but with real dividend income along the way. It delivers VIG's commitment to quality, but with more yield and better upside. It captures VOE's value discipline, but does it with stronger companies and better risk control. And it gives you DVY-level income, but with smarter diversification, less concentration risk, and actual capital appreciation. So instead of settling for one type of strategy, growth or income, stability or performance, you get a fund that blends the best parts of all of them. That's what makes SCHD different. That's why this is the one ETF I'd pick above all the others. If I had to put all my chips on one ETF for the next 30 years, this is it. Now, here's where it gets really exciting. What happens if you actually stick with SCHD over the long haul? Let's say you don't start with a huge lump sum. You just invest $7 a day, the cost of a sandwich or a streaming subscription. And from there, we let 3 powerful forces go to work: a dividend yield of 3.75%, an average dividend growth rate of 10.77%, and a share price that's historically grown about 7.61% per year. Here's what that looks like over time. In year 1, you'd have invested about $2,555. At year 10, your portfolio would be worth about $45,000, generating around $2,000 a year in dividends. Fast forward to year 20, the portfolio will be valued at $209,000 and dividend income crosses $12,000 per year. Now, fast forward to year 30, and this is where things really take off. Your account balance would hit roughly $953,000, and your yearly dividend income would hit $75,000, or about $6,250 per month. All of that from just $7 a day. You might be thinking, hey, the other ETFs perform pretty well too. And you're right, each one has its strengths, and depending on your priorities, any one of them could play a role in a solid portfolio. But let's step back and compare them side by side, specifically in two key areas: how much your portfolio grows and how much income it actually pays you. And see why I have SCHD as my one best ETF in 2025. Let's start with the big number, total portfolio value after 30 years. If you stick to just $7 a day, I will start from the bottom and work our way up. VOE comes in with a final portfolio value of around $450,000. It's a value-focused ETF, and while it's consistent, it's also more conservative, so the overall growth stays modest. Next up is VIG, finishing with about $503,000. It's steady and reliable, but because it plays things safe and sticks to lower-yielding stocks, the growth doesn't compound as aggressively. DVY edges ahead slightly at $528,000. That extra boost comes from its higher income payouts, but since it doesn't grow as quickly, it levels out right in the middle of the pack. Then there's SPY, finishing at a solid $605,000. Its strength is capital appreciation, so if you're just looking for your investment to grow over time, this is one of the stronger contenders. But leading the group by a mile is SCHD, with a final portfolio value of around $953,000. That's nearly $500,000 more than VOE, the lowest performer in the group. And even compared to the next best, SPY, at $605,000, SCHD still pulls ahead by almost $350,000. Now let's talk about income, because this is where things really start to separate. At the very bottom, we've got SPY, bringing in just about $1,000 a year in dividend income after 30 years. VIG does a bit better, delivering around $4,000 annually. It's focused on quality and dividend growth, but the yield stays low, so income takes time to build and it never really takes off. VOE steps it up with about $22,000 per year. That's a respectable middle ground. Decent yield, moderate growth, not bad at all. Then there's DVY, the income specialist. It's designed for payouts and it delivers around $31,000 a year in dividends. That's a strong result if you're focused purely on cash flow, but sitting far above the rest is SCHD, pulling in an estimated $75,000 a year in dividend income. That's over $44,000 more than DVY, and a massive $74,000 more than SPY. That's the difference between picking a fund that pays you and picking one that could fund your life. Want to know how to turn a one-time $500 investment into a portfolio that pays over $5,000 in monthly dividend income? Click the video on screen to find out.